if a central bank starts to raise rates in order to protect the currency and the currency falls anyway, that is the early canary in the coal mine of a very, very bad situation.
Please disperse. Nothing to see here, please.
Hello, everyone, and welcome back to Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson, the man behind the dollar milkshake theory, which is why the word milkshakes is in our name. If you don't know what that is, you can learn more on our YouTube channel. We have a playlist that says start here, and it will fill you in on all that fun information. We are frequently talking about markets, and we like to spice in some of the madness that goes on in the world and in markets. It was quite a week for markets and for madness, Brent. I want to kick us off because this is going to probably be a busy episode for us. So I want us to jump right into the markets piece, and then we can find our way down the yellow brick road to madness. It was a week for central banks, and probably the biggest mover the biggest news to start the week was the Fed's FOMC rate decision, where they decided to pause. And then, not to be outdone, the BOJ, the Japanese central bank, had a surprise announcement of their own. There's quite a few others that I want to trickle in there, but why don't I hand it off to you to address those first two market movers?
Sure. Well, the Fed came out, and nobody expected them to raise rates this year. But nobody expected them to cut rates at this meeting. At the beginning of the year, the Magnificent Seven was the 7 rate cuts that the Fed was going to deliver. And by the time we got around to this meeting, that had come down to like 2 or 3 expected. But nobody really expected at this point for it to happen in March. But I think there was some people expecting them to be, at least a little bit hawkish because, the data that had come out was not super dovish. In other words, inflation was staying a little bit sticky. In other words, it wasn't rising anymore, but it wasn't falling either. And you could, there's nothing to say in the data that he needed to be dovish, but he was pretty dovish. And again, it kind of gets back to what we've talked about a little bit over the last month or so, is that the Fed seems to want to cut rates. Now, why exactly they want to, that's up for debate, but it's pretty clear that they want to cut rates. And, Powell did nothing in this meeting to dissuade that idea. And so the market kind of rallied pretty hard on that. Equities rallied pretty hard. The dollar sold off very hard on that news. But what was really interesting is 24 hours later, it had all been reversed, or at least on the currency side, it had all been reversed. Equities stayed fairly strong. They sold off slightly on Friday. But, from where it closed on where it closed after the Fed meeting on Wednesday, I think the dollar rose close to 1%, over Thursday and Friday. And all of the losses that it had experienced on Wednesday post Powell were gone by midday Thursday, and were gone, and then gone even more on Friday. So it's one of these things where, you and I have talked about this a lot, is that it's not totally up to Powell what the dollar does, or in other words, currency markets cannot totally be forecasted just on the Fed. And that's the point, is even if the Fed is dovish, if the rest of the world is more dovish than the Fed, or if expectations change, at the end of last year, expectations were that the Fed was going to be the most dovish central bank. And so markets move on expectations, and so the dollar sold off. But now, even though Powell is dovish, the rest of the world is starting to get a little bit dovish as well, except for the BOJ, right? And Turkey. But Brazil cut, Switzerland came out with a surprise cut. Lagarde kind of indicated that they might not be able to wait that much longer before cutting. And as a result, the dollar moved higher. And what was interesting, though, really was the BOJ is, people thought that, they're going to go on this interest rate hiking spree now. Well, they did raise for the first time in what is it, was it 15 years, 17 years, a very long time. And a lot of people had been forecasting that would be bullish for the yen. And again, markets move on expectations, right? And so the market, the yen had been moving up on this expectation. So the hype by the BOJ was no longer a surprise. And it had already been largely priced in. And that's when they came out and they said, we raised, but we're not exactly going on a hiking cycle. And I think the guy even came out and said, we're going to keep monetary policy pretty easy, for lack of a better way of saying it. And as a result, the yen sold off hard. And so now we're kind of where we were, a few weeks ago, 2 or 3 weeks ago, with the dollar kind of back with the highs of the year and, these other currencies selling off. But what's interesting is that bonds rallied as well. A lot of times if rates are going higher or they're not falling, then you would expect, bonds to sell off. But, if rates are staying high, and then you wouldn't expect bonds to rally. But so the bond market kind of took it as a dovish Powell. The equity market took it as a dovish Powell. And I think what the message there is that the Fed can be dovish, but if everybody else is more dovish, then you can get equities going higher, you can get bonds going higher, you can get the dollar going higher altogether. So again, you can't just take one variable and automatically use that one variable to determine which direction a currency is going to go.
All right. Well, look, I think we have a pretty committed audience and we appreciate everybody. But for anyone who's kind of new to some of these topics, you definitely did a flyby on some things that are probably worth going a little deeper on. Before I tee that up for you, I will add some context. So like you said, the Fed paused. They did not raise their benchmark rate. Japan raised 10 basis points. It was almost kind of more of just like I don't know. They're just trying to get off a zero.
A token raise.
A token raise. Brazil cut 50 basis points. Their rate is now just under 11%. The Swiss cut 25 basis points. They're at 1.5% now. Turkey did a surprise 500 basis points or 5% raise. They're now at 50%. So if you want to get risky in Turkey and give them your money for overnight, you can get 50%. And then we will talk a little bit about China because they're kind of navigating all of this news somewhat on their own and at least in their own way. But what I want you to circle back on a little bit here is address the term hawkish dovish and why it matters at this part of the cycle with Jerome Powell. And in addition, why do we care as a collective about what the global central banks are doing? Are they making coordinated decisions? And specifically, maybe you can reference the carry trade in Japan. Why do you think the dollar moved opposite what it might have done given the fact that, the BOJ raised? So there's kind of two parts there. Yeah. Maybe start with the dovish hawkish part and then talk about just these currency relationships a little more.
Okay, sure. So just in general, dovish, a bird of dove is seen as the bird of peace, right? And if you are dovish, or if the central bank is dovish, or if monetary policy is dovish, that means it's kind of being nice and easy, right? And so typically if you lower rates, you are lowering rates in order to be very nice and easy and make it easier for businesses to function and make it easier for people to borrow, make it easier for the economy to expand. And so that is often characterized as dovish. The opposite, a bird of prey or a predator, would be a hawk, right? And so that's the opposite of a dove. And that's when the central bank, the monetary authority, the government, whichever authority that you want to reference, when they are being tougher with the market or stronger with the market, or if they're trying to scare the market, like a hawk would, then that's typically would be characterized as strong monetary policy or tight monetary policy or the raising of interest rates. Again, it's not a hard and fast rule. We've seen over the last couple of years that interest rates have gone higher and the markets have gone higher with them. So it doesn't automatically mean that asset prices fall when you raise rates. But typically, when you raise rates, it makes borrowing more expensive. It doesn't mean it kills borrowing, and it doesn't mean you can't still make money if interest rates are higher. It just means that the hurdle to make money over the cost of your funds to borrow is harder. It's tighter. It's more challenging, and that is seen as a hawkish monetary policy. And you will see central banks and monetary authorities do that to kind of rein in kind of the animal spirits or inflationary pressures or whatever it is that they think that is expanding too quickly. Now, as it relates to Japan and the carry trade, that probably needs a little bit of explanation as well. A carry trade is basically when you borrow in one currency and then you go invest it elsewhere. And a carry trade is the cost of carry. That's where it comes from. The cost of carry is you're carrying that debt load. So if you're carrying the debt load, not only do you have to pay off the debt at the end of the term, but you have to pay the interest rate or the servicing cost on that debt. So if the cost of carry is low, then that is a currency that you would borrow in because your cost of carry is lower and you don't have to meet such a stringent hurdle to make money. If the cost of carry is high, that would be a more challenging environment. It doesn't mean it would be impossible. It just means it would be a more challenging environment in which to make money. Because if you're borrowing at 5%, if you're borrowing at 0% and you make 3%, that's great. But if you're borrowing at 5%, now you have to make at least 5% just to break even. So if you only make 3%, but you're borrowing at 5%, you're losing money. And so where this relates to the yen carry trade is that the yen, for, like you said, John, for 17 years, they've had rates at 0%, right? And so the cost of money in Japan has been free for 17 years. And so what people have done is they've borrowed in yen, or they sell the yen, they take, the money from selling or the borrowing, and they go invest it elsewhere. They go invest it abroad. And if you even get 1 or 2% return and you lever it up 2 or 3 times, now you've got a 6% return and a 0% cost of carry. That's a pretty good business for people. And so the yen has become a huge carry trade over that 15 years. Because again, as long as you make a little bit of money, your cost of carry is 0. Part of the reason that the cost of carry has been 0 is the central bank of Japan, the Bank of Japan, has pegged interest rates at 0 and even negative, right? And so part of the reason that they have now finally, for the first time in a long time, decided to raise rates is they have finally, for the first time in 17 years, started to get a little bit of inflationary pressure. And not only that, but it's hard for their banks to make money if their yield curve is negative or if their yield curve is flat. And so they finally decided we want to get off of 0 and raise rates a little bit. And so if you raise rates, that on a relative basis makes the currency more attractive, right? And so if Japan were to start raising rates dramatically, not only does it make the currency more attractive to other people to buy it, it starts putting pressure on the people that have sold it short or the people that have borrowed in it, and that potentially causes a short squeeze, and that's when you see the unwinding of the carry trade. So the unwinding of the yen carry trade would mean that all of the funds that were borrowed, flow back to Japan, and they pay off of that debt. And that would mean liquidity leaving other parts of the world, right? And when liquidity leaves, that's typically negative. So the unwinding of the yen carry trade could be very, very hard, or it could be very it could be very negative for global markets. I've said before that one of the biggest dangers I could see is if the yen and the dollar were the 2 best performing currencies in the world, because the biggest carry trade in the world is the dollar. There's more money borrowed in dollars by far than any other currency in the world. The next one is the yen. So if you have both of these cases where the deleveraging is happening, people are rushing to pay off this leverage and deleveraging, paying off this debt, that means they're contracting liquidity. Again, markets expand when liquidity expands. Markets contract when liquidity contracts. And so the unwinding of the Japanese carry trade, yen carry trade, along with the unwinding of the US dollar carry trade, would be very bad for markets, in my opinion.
Well, look, for those who don't know what the dollar milkshake theory is, please watch some of those videos in the Start Here playlist. But let me give you a quick synopsis. If you're familiar with the movie There Will Be Blood, or if you're not, there's an infamous scene where he talks about drinking the milkshake of the other landowner, where he's draining basically the oil from underneath. Brent has used this as an analogy for how the US dollar as the global reserve currency and the US as the world's largest economy eventually draws in and sucks all the liquidity back to the US, particularly in a crisis. So with that in mind, that kind of hopefully gives some context to where, some of these views are coming from, especially as you're talking about a carry trade where people around the world are borrowing in US dollars. And they're then doing whatever they're doing in their local economy, taking out business loans or trying to grow businesses, or just speculating. And then if there's any kind of shift in the currency markets, particularly if their currency that they're in is getting weaker than the dollar, they have to pay off now an even larger debt than before because of that change in currency rates. So if the two biggest markets that people are borrowing from, Japan and the US, continue to rise together, that's going to choke out a lot of other people's economies. Based on what has happened by the BOJ, this recent rate hike decision, one would argue that would put some pressure on people who've been borrowing in yen for free and taking leverage bets or what other types of carry trade investments they might be making. But ironically, normally in that type of environment, yen would flow back to Japan and put upward pressure on the yen and make it appreciate. But that wasn't the case here. Do you have some thoughts on perhaps why the market just kind of brushed it off?
Well, I think part of it, again, is it's a relative thing. Even though the Bank of Japan did raise rates, they are still dramatically easier than the U.S. is, right? And it's a relative gain. And so, again, even though the Fed is talking about cutting rates, rates are still very high. Rates are still at 5.5% versus 10 basis points or whatever it is for Japan. That is an enormous spread. So, again, you could argue that Japan would have to raise a lot in order to draw in capital away from the dollar and into the yen. Now, again, it puts a little bit of pressure on the people that are already short the yen, but there is still a huge demand for dollars, and on a relative basis, the U.S. still has much tighter policy and much higher interest rates. So I think that's part of it. The one thing I would note, and I do not think that this is the case with the yen now, but it could be the case with the yen in the future, and I do think it is the case with other currencies. And that is if a central bank starts to raise rates in order to protect the currency and the currency falls anyway, that is the early canary in the coal mine of a very, very bad situation. And that is part of the reason you referenced Turkey, right? Turkey had to take interest rates from 45% to 50% or whatever it was. Think about that. You're paying 45%. And yet the currency is still falling. The reason interest rates are that high is because they are desperately trying to keep capital in Turkey and trying to attract other people to come buy it. So think of it this way. You can buy a U.S. Treasury, 1-year U.S. Treasury, and you get paid 5%. The likelihood of you not getting the 5% back is extremely low. You could also go buy a 1-year Turkey bond, right? And you will get 45%. Now, the reason they're offering 45% is because it's very possible that the currency is going to lose 45% versus the dollar over the next year, right? And so they have to put that amount in there in order to attract capital. Now, maybe they offer 45% and maybe the lira only falls 30% versus the US dollar, in which case you still make 15%. That's great. But again, if you have to go if you're paying 45% and your currency is still falling, and you have to now go to 50% in order to get, you have to take it. Think about that. You're offering 45% and it's still not high enough to get people to come buy your currency. And then they had to take it. And this is a very big dramatic difference between Turkey and Japan. So I don't want to say that I'm equating that, but I'm just using that as an example. If it got into a situation where Japan continues to raise rates and the yen continues to fall, that's not a good situation. And that is what happens in emerging markets when they start to raise interest rates and the currency falls. Now, it has been alleged that over the last couple of years, that the part of the reason the U.S. was raising rates was to, quote unquote, save the dollar. Now, I've gone on ad nauseum about why the dollar does not need saving. But argument has been made that they raised rates in order to save the dollar because there was so much de-dollarization going on that if they hadn't raised rates, then everybody would have sold the dollar and left the U.S. markets, and it would have been a disaster for the United States. Now, I'm not saying that that could never happen, but we're just not in that situation right now with the U.S. But what the situation we are in, for the reasons that you pointed out, because many people around the world fund themselves in dollars and they owe all this money in dollars, the U.S. has the ability to use the dollar as a weapon. So if you want to say they were raising rates to use it as a weapon to make it stronger versus than other currencies, then I would say you are not only potentially right, I would say you're absolutely right. I'm convinced they do. That's part of the reason that they were raising rates. But there's a difference between swinging a sword in an offensive manner and using a shield in a defensive manner. The U.S. is not in the situation where they have to use the dollar as a shield. They are in the very lucky position of being able to swing the dollar as a sword.
Well, I want to stay on this just a little bit longer because there's something you mentioned that I found interesting, and let's keep in context here that Japan only raised a very small amount, 10 basis points. Relative, it's means something because they were at zero for so long. But you made the comment about, well, one of the reasons they have done this is the banking sector is struggling to function because there's really no way for them to make money the way they normally would. At the same time, in the US, one of the biggest issues that we've seen over the last 2 years with the Fed aggressively raising interest rates has been the impact on the banking sector. Now, a lot of that comes down to the bonds that the banks were holding as collateral, and a lot of that comes to regulations that they have to do that. Some were doing it because it's part of their investment portfolio strategies. But when you own a bond at 50 basis points and suddenly the same type of duration bond, let's say a 10-year, is now 500 basis points, that 50 basis point bond just lost a lot of value. And when we were having these different types of bank scares, you had Silicon Valley Bank go under. People were requesting their deposits back. And in order to fulfill those deposits, banks would sell their various assets, including bonds. But if they sold these bonds that were, 60 to 70% undervalued, they would also have a bankruptcy issue. The Fed came out with a bank term funding program, the BTFP, which allowed them to pledge that collateral for 100 cents on the dollar. It was a loan that the Fed then provided the banks to fill that liquidity gap. So we did have a bit of a banking crisis, so to speak, momentarily, but wouldn't the fact that Japan and Japan's banking sector being able to exist for 17 years at 0% interest rates give us a little bit of confidence at this point that the U.S. banking sector is not that bad?
Yeah, so I've talked about this several times, either on conference calls or presentations. You and I have discussed it on this channel several times. So for people that are interested in this topic, there's some posts or there's some previous episodes where we go into this in a lot more detail. But part of the reason that I am extremely skeptical of this yen hiking cycle, and again, I'm not saying they can't do it, but I would say they can't do it forever, and I'm going to tell you why. The part of the reason they can't do it forever, and part of the reason every time they have hinted at it previously, they have then very shortly thereafter had to go in and buy government bonds in response, is because, to the point that you just made, when the U.S. started raising interest rates, banks that had bought very low yielding treasuries found those treasuries underwater. Prices then were falling as interest rates were rising. But what the U.S. banks did not have on their balance sheet was negative yielding treasuries. But guess what the Japanese banks do have? They have 15, 16, 17 years worth of negative yielding treasuries. So the U.S. was able to take interest rates to 5%. It caused a problem in the banking system, and they had to set up a special facility to fill that hole. Japan does not have the ability to take interest rates to 5%. If they even take interest rates to 1% or 2%, the entire banking system goes bankrupt because they are chock full of negative yielding treasuries. So as interest rates start to rise, those...
You don't mean treasuries, you mean...
Sorry, I mean Japanese JGBs, Japanese government bonds. So Japanese treasuries, they're chock full of Japanese treasuries. And they are negative. They bought them when they were negative yielding. So as interest rates rise even a little bit, those fall dramatically in price. And that is part of the reason why Japan has had low rates for so long. If they go on a hiking cycle, their entire banking system very quickly goes into crisis. And that's why it was in September of 2022, when the dollar was at its 30-year high, the Bank of Japan not only had to bail out the JGB market, but they were also having to bail out the yen market because, what's crazy about that is the policies in which you would save the yen hurt the JGBs, and the policies that would save the JGBs hurt the yen. They're going to have to sacrifice one of them. They cannot. You can save both of them for a very short period of time. You cannot save both of them over a long period of time.
Got it. And again, all that plays into the dollar milkshake theory. We encourage you to watch that Start Here playlist. Brent, while we're on credit, before we move on to something else, let's talk about maybe the yield curve for a moment here. The yield curve, one of the ones that's measured the most is the 2 and the 10-year. Typically, a longer duration bond should provide more yield because you're taking risk for a longer period of time. Typically, in moments of uncertainty, you will see a capital flight to longer duration for that safe haven, and then it ultimately pushes those longer duration yields lower than short duration. That yield curve has been inverted in that type of way since July 5th of 2022. At the end of this week, we had 625 days of that inverted yield curve. It's the longest yield curve inversion on record. People like to use yield curve inversions as a recession indicator. There's usually a 12 to 18 month lag. We've, obviously not long since, but we have surpassed that. What are your thoughts on the yield curve inversion, why it's still inverted, and do you put any onus on this as a signal, since maybe this is kind of a new paradigm?
Well, here's the thing: is I don't actually think it's a new paradigm. But the other thing is that people very much like to quote the inverted yield curve as the perfect predictor of a recession. And to your point, it usually comes between 6 and 18 months. But there's various, you go back, I don't know, there's been 7 yield curve inversions, and they've all led to a recession. And one of them came within 3 months, and the longest came within 18 months. So there's various, others, in between those two bookends. But what they never, ever tell you is that until the recession comes, equities go higher every time. So, the idea that the yield curve inverts and you should automatically go sell your risk assets because it means that the recession is coming in a very short period of time is just completely disproven by the facts. And again, you just don't take my word for it. Go up and look it up for yourself. And again, there's nothing to say that the 18 months or whatever that previous longest time period was is the maximum amount. And the thing is, at some point, of course, we will have a recession. So, but I do kind of feel like that there should be some kind of a terminal period of time to which you should be able to say, well, it didn't cause the recession. Because if it inverts now and then 20 years from now we go into a recession, well, can you really say it was because of the inversion 20 years before? Now, that's an extreme example, but that's kind of my point. I do think that it's likely that we will, I've said this for a while, I think it's likely that we're going to get a pullback, but I am not convinced that we're going to get a recession. I don't want to say it's different this time, but we could just be in the same type of a paradigm, but it's just the fractal is longer, right? Again, I don't remember when the 18-month one was, but it's very possible that was the last one that was the longest, and the previous people were looking at saying, well, it can't go more than 9 months, and then this one went 18, right? And so, maybe we'll go 3 or 4 more months and then we'll have a recession, right? And then the other thing is they kind of messed around and changed the way they calculate recessions, right? You could almost argue, well, we did have a recession, but we came out of it pretty quickly. You could probably say in the first 6 months of 2022, we had a recession. Technically, we didn't have one, but you could kind of say that was it, and now we're coming back out of it. Again, I am of the belief that markets are due for a pullback, and I think we've come a very long way without a lot of pain in the market. And I typically, or in my 25 years of doing this, tells me that markets don't go in a straight line. But I'm not convinced that we're going to have this massive recession and we're going to go into a 3-year bear market and it's going to be the next Great Depression. I know a lot of that's a lot of people's prediction. That's not mine. I'm not saying it can't happen, but that's not my base case. I think that for a lot of the reasons that we've talked about a lot on this channel is that we're in a situation where the debts have gotten so big that the central banks just can't let things go down for very long without crises happening. So it doesn't mean that markets won't go down. It doesn't mean we won't have short-lived crises, but I don't think they will last very long before the central bank's monetary authorities come in and put programs in place to try to push them back higher. And while I don't think they will be successful everywhere around the world, I think the U.S. will be the last to fall. And so I'm not convinced that the U.S. goes into a recession right away.
Awesome. Well, that leads us kind of into another interesting data point on the calendar is the March 20th of this past week was the 4-year anniversary of the COVID low. Since then, I'm going to throw out some stats. This kind of corroborates what you just said, but, pick up this baton as well and give us your thoughts. The 4-year total return is 150%. That's 25% annualized. What's interesting is the 4-year period after that COVID low also resembles 1982 and the 2009 recoveries, which, by the way, after that 4-year benchmark or 4-year timestamp, things did continue higher. The current bull market is in line with 11 previous bull cycles when you kind of look at PE ratios and earnings and a number of other percentage increases. And then last week, we saw the greatest number of S&P 500 stocks hitting their 52-week high in 3 years. So it would suggest that maybe the bull run is starting to become more robust. However, the S&P 500 is only 9% higher from 2 years ago, and only 30% of stocks' earnings are at 2-year highs. So we talk about drawdowns a lot and how that can affect earnings. So although we are higher, depending on where you're positioned, if you didn't have the right defense in place, the drawdown you would experience in 2022 would only have you about 9% higher. And again, that rally since then hasn't really brought everyone along for the ride, at least fundamentally, when 37% of earnings are only at 2-year highs. So is there anything here you want to pick out? One of the things I will highlight for myself is this 25% annualized return. Do you think that in any kind of way is a reflection of what the real measurement of inflation has been?
No, I don't think it does. And I think part of the reason that you see markets where they are is, I'll reference earnings here. I personally don't think earnings are that important. It's not that they're not important, but to me, they're not the most important thing. To me, the most important thing is liquidity. And if markets are liquid and people are able to borrow and able to fund businesses, and that the area of the world that is able to draw in capital and liquefy markets are going to do well. And if you don't have liquidity and you can't attract capital, you're going to do poorly. And again, this kind of goes back to my entire framework. Even though the U.S. has raised rates, markets are pretty liquid right now. Spreads, when we talk about credit spreads, typically the U.S. Treasury is kind of referred to as the risk-free rate. That doesn't refer to the fact that you can lose money if interest rates go up and down. It's talking about principal and payoff. But then more risky bonds will have slightly higher yields than a Treasury. And so the spread between a Treasury and, say, a AAA rated corporate bond or a BB corporate bond or a junk bond, typically the riskier will have a higher spread over a Treasury. And in a really risky environment, that spread will expand. Well, right now, spreads are very tight. But in other words, risky companies don't have to pay that much more than a Treasury to get funding or to service their debt. And so that shows that there is liquidity in the market. There's enough liquidity in the market that people are willing to fund these riskier business at slightly higher interest rates than the risk-free rate. And we referenced Michael Howell last week on the episode. He is somebody who calculates global liquidity. And again, global liquidity is pretty high. And as long as global liquidity is high and people are, again, the interest rate, it really doesn't matter that you're borrowing at if you can make more than what you're borrowing at. So in other words, if you're borrowing at 2%, but you can only make 2.5%, I would argue that's riskier than borrowing at 4 and making 8, right? Because your cost of carry is higher borrowing 4%, but if you're in an environment where you can make 8%, I would borrow at 4 and make 8 10 times more than I would borrow at 2 and make 2.5. And so, interest rates are higher, but markets are liquid. And so I think liquidity is what's driving market. And again, that is why the U.S. is outperforming the rest of the world, because we have the most liquid markets in the world. Now, does that mean that they're perfect? Does it mean that the earnings are going to keep going higher? Does it mean that valuations are appropriate? Not necessarily. It just means they're the most liquid on the planet. And as such, they're going to get the capital flows. And it becomes kind of a reflexive thing. The most liquid market gets more liquid. The least liquid market gets less liquid. And it's not fair, but it's the way it is.
Excellent. Well, adding to that, I never really poked the bear about China. If China did a deval, how would that affect global liquidity in your view?
That would be horrible for global liquidity. So think about it this way. China has been, it's a soft peg. So from I don't remember the exact year, called it 1990 to 2015, the yuan was pegged to the dollar at like, I don't remember what it was, 7 or 7.5 or something. And then, actually, I don't remember the rate, so don't quote me on that, but it was pegged for a number of years. And then in August of 2015, they let the peg go. And it wasn't a huge devaluation, but it devalued by like, let's say 5%. And they did that because the currency was too strong because it was pegged to the dollar. The dollar was strong. They pegged their currency to the dollar in order to take away currency risk for investments going into China. And when they devalue, the reason that you would devalue is if you are facing deflationary pressure inside your country, you would want to pull capital, you would want to pull liquidity into the market, or you would want to pull inflation into the market, and you would want to send deflation out. You want to get rid of your deflation. So you devalue your currency. That makes it that if you devalue your currency, that means your currency is losing purchasing power. That means you're bringing inflation into the country. If you're bringing inflation into the country, then you've got to be, that deflation has to go somewhere. So in that scenario, the yuan loses value, which means the dollar goes up versus the yuan. In that scenario, China would be exporting their deflation to the rest of the world. That would be again. Think about it again. I can't remember the exact amount that they devalued in August of 2015. But go back and look at markets from I think it's the second week of August 2015 to the second week of September of 2015, and look and see what global markets did. Look and see what the VIX did. Look and see what spreads did. Again, just that small minor deval sent markets in kind of haywire for about a month. And again, it's because China was trying to get rid of their problems, give it to the rest of the world, and pull the liquidity that the rest of the world had into China. And so if China were to come out and do, there's been speculation, because it's been getting weak, and subsequent to the mini deval, then they didn't perfectly peg it to the US dollar anymore. They kind of quasi pegged it to a band. And so it's a managed currency, but it's not a hard peg. But it's been getting weaker because China's economy just keeps falling lower and lower and lower. If you, this is kind of interesting. Xi is often hailed as this great visionary leader. Go back and look at he's been in power for, I think, 10 or 12 years. Go back and look at all the economic statistics of Japan over the last 12 years. They all go down. They're all on a decreasing trajectory.
You meant China, sorry.
Sorry, I meant China, not Japan.
It's late in Puerto Rico, so
yeah. So, but my point is like things are not great in China. I know everybody likes to think no matter what China does, it's this great strategic 3D chess move that nobody could have seen coming. And so the fact that their real estate market's down 70% is actually a good thing. The fact that their stock market has crashed 60%, it's actually a good thing. It's nonsense, but that argument is out there. Just go check my Twitter feed. Anyway, not to digress, but but the point is things are bad in China. China has a lot of deflationary pressure. The problem is that they also have inflationary pressure because they have to import needed imports. They have to import food, they have to import water, they have to import energy. If you devalue your currency, that makes those needed imports more expensive. So you kind of jumping out of the fire and into the frying pan. But eventually, as everybody knows, governments tend to try to get rid of their bad debts by inflating away the currency. And one way to do that in one quick fell swoop is to devalue the currency. So if China, there's been speculation because it's weakening again now that they're gearing up for another deval because they have massive deflationary pressures internally in China. And so if they did that, that would be very deflationary for the rest of the world.
Well, I appreciate that. One last note on the liquidity front. One of the main beneficiaries of liquidity the last, let's say, 2 years has been the crypto market, specifically Bitcoin, which bottomed around 15,000, is now hovering around all-time highs, reaching just shy of 70,000. We've seen a bit of a pullback. We've actually seen some ETF outflows. Some of that recent surge in price arguably is because of the ETFs. What are your thoughts on, the current state of liquidity and maybe this slight pullback? I don't think anyone's trying to jump to conclusions and say that the high is in and it's all down from here for Bitcoin. But any thoughts on some of this liquidity movement?
Well, I think that liquidity is very high right now, but I think as we move forward, I think liquidity is going to become less available. And I think Q2, again, I'm going to reference this conversation that we referenced last week because I think it was a very good one. In last week's episode, I recommended that people go listen to Michael Howell of Cross Border Capital, listen to his interview with Thoughtful Money. He also did one with Grant Williams recently, which was great. And he did one with Dimitri Kofinas as well. So he's been out there a lot over the last couple of weeks. They're all fantastic. I recommend that you listen to him because his view is very similar to mine. He thinks liquidity is pretty plentiful right now. He thinks we're in a bull market. He thinks we're probably going higher, but he also thinks that Q2, nothing goes in a straight line. We've come a long way. The easy money is kind of behind us. So even though he thinks we go higher in the future, or let's call it over the next 12 to 18 months, there will be periods of where liquidity, maybe it doesn't disappear, but it pulls back a little bit. And Q2 is kind of a natural time that could happen for a number of reasons. And I think that's right. And I think it's very possible that, in Q2, we get some kind of the dollar maybe goes a little bit higher. Maybe we get some, with what's going on in Russia, with what's going on in the Middle East, with what's going on in Israel and the Red Sea, with what's going on in China. We have the potential that the dollar gets a little stronger between now and the summer, and that causes a little bit of a pullback. I mean, ultimately, I think the Fed is not going to be super hawkish going into, the election. I think it's more likely than not they're going to, if they're going to raise rates, I think they're probably going to do it either at the May meeting or the June meeting. I don't think that they're going to do it, leading right into the election. But if we got some volatility and a little bit of lack of liquidity over the next couple of months, that kind of gives the Fed cover to cut rates once. But if markets really turn down, then liquidity will dry up and the Fed and the other central banks will come in and try to re-liquefy markets. But I think we're kind of moving into a part of the year where liquidity, it would not be surprising for liquidity to not disappear, but to become less plentiful.
Well, look, speaking of this terrorist attack in Moscow, and I think overall the conversations that we've been having today, it's frequently said that war is inflationary, but if we had a really significant global war, wouldn't that seize up markets to the point where it'd be incredibly deflationary? So comment on that and some of your thoughts on what transpired in Russia recently.
Yeah, so war is a couple things. It's both deflationary and inflationary, I guess stagflation is the word. And literally that's the worst of all worlds. When economic activity falls, but prices rise because of supply constraints. That's kind of what we had at the beginning of 2022. So go back and look at the beginning of 2022 and see if that was fun for anybody. Probably not, right? And so, I mean, that's it, and that becomes really, really bad for emerging markets and some emerging markets that produce commodities that are needed for the war effort. Perhaps their exports go up because those commodities are in demand, but their cost of living is going up as well. And again, the dollar, we get into a war, the dollar price is going higher. That's gonna cause funding pressure for these. So it's just a really, really bad situation. Again, this is part of my thesis. So again, I don't like to talk. I don't like betting on this, but I can't ignore it either. And that is that, it just seems to me that we're in a stage in history where cooperation is waning and fracturing is taking place, and the pendulum is swinging from peace and love to hate and war. And I hate it, but it just seems accurate to me. And I think it'd be fantastic if cooler heads prevailed, but I don't think it's going to. Unfortunately, there was a horrible event in Moscow where citizens were, I think the number's up to 130 or 140. People were in a mall shopping, and people were at a concert hall that was hooked up to the mall, and gunmen came in and just started firing basically, and they set the place on fire. And so it's a horrible, horrible thing. And the crazy thing to me is, there's so many people out there that already have this all figured out. They know exactly who it was. It was, it was the West, it was Ukraine, it was the CIA. And listen, I don't know who it was, but this is the point that I'll make, is we're at a point in history and time where I think this stuff is unfortunately going to continue. What I would say is those who are absolutely certain that this is caused by in the West, whether you want to say that's the U.S. or Europe or Ukraine or whoever it is, I would say, why are you so certain that's the case? Number one. Number two, is it possible that you're wrong? And the other thing I'd say is, I think it's very fashionable now to blame everything on the U.S. and say it's all our fault. And again, perhaps there is some fault. I'm not saying there's not, but a year and a half ago or a year ago, there was a coup in Russia, and so many people thought that this was like a 3D chess move by the master Putin. I mean, okay, maybe. And now other people are saying, well, this is, I saw people last night saying this was another move by Putin to drum up support locally and be able to blame, it's a false flag by Putin. I don't know if people know this, but when Putin came to power in 99, he was kind of a relative nobody. And Yeltsin wanted him to become president, but he wasn't popular. And so then in the fall of that year, before elections took place, there was terrorist activity that took place in some of the southern Russian regions. I think it was Chechnya and Georgia. And Putin went in there, led a military operation, cleaned out the terrorists, made everything okay, became a national hero, and all of a sudden he gets elected. Now, again, I don't know what happened there or what did happen there, but I know there are some people, there's even been books written about it that says this was a false flag by Putin in order to drum up popular support for him. That's one side of it. The other side of the story is that there's southern separatists, Muslim faith, who did not like what Russia was doing, meddling in their country, and this was their way to react to it. Again, I don't know which one of those stories is true. I'm just telling you, both sides are out there. And it's the same thing now again. It was Muslim related. As far as from what I've heard and from the evidence I've seen, it was ISIS that was there. Now again, who funded them? I don't know, but immediately it's come out that some people think it was the CIA, some people think it was Ukraine. Putin has come out. Listen, Putin does not have a choice. Putin is going to go for somebody. I think some people would say, well, he could just sit back and do nothing. No, he can't. He can't do nothing. Politically, he can't do nothing. So he has to find somebody to blame. And regardless of whether it is true or not, it doesn't matter. It helps him to blame the West, right? So again, you have to, I think it's very important when you're analyzing things like this is you need to understand what he can and what he can't do. And again, it doesn't really matter what's true and what isn't true. He cannot go to his people and say, you know what, let's just pretend for a second. Again, I don't know. Let's pretend for a second. It had nothing to do with the West. It was all related to the Muslims in the southern part of Russia, seeking revenge for some of their believed atrocities against them. Let's pretend just for a second that was the case. Putin cannot go on to his people and say, you know what, this is time for some self-reflection on our part. We probably should not have treated them the way we treated them. While I don't agree with the way that they reacted, it is kind of understandable. He cannot do that, right? And if the same thing happened in the U.S., Biden can't do that either. And so there is going to be a reaction. Now, whether that happens on Monday, whether it happens in May, whether it happens a year from now, I don't know. But there will be blowback from this. And my guess is that it will be against the West because, again, whether it's true or whether it isn't true, it helps Putin to say it was against the West. And so unfortunately, these are the types of things that eventually lead to bigger conflicts. And then those bigger conflicts become wars. And so I hope I'm wrong. I feel horrible for the innocent citizens of Russia who were killed, regardless of who killed them. But it just seems like this kind of stuff is happening more often. And so I'm going to reference something else. I think we've talked about it on this show before. And I'm laughing because if you don't laugh, you cry about this stuff. It's like, I honestly think the best investment that people can make is find a group of people or some people in your family or locally or online or wherever it is. Find a group of people that you can agree with and disagree with, but be able to count on them and lean on them and cooperate with them if things really go bad. Because I think having a group of people that you can talk about hard things with without being afraid of losing their friendship or offending them, I think that's going to be very important to have over the next few years.
Well, look, if things get really bad, we'll just have to escape to Cuppy's Finca and pick up a machete and a shovel and get to work. But yeah, it does seem like there's all kinds of winds blowing, and as part of that, both politically, geopolitically, and financially, we may see some blowback in unexpected ways. So the best thing to do, as Brent always says, is be prepared, and be prepared certainly for the unexpected. We appreciate everyone who joined us this week. If you want to find Brent on Twitter, you can do so at Santiago AU Fund. You can find me at John Kutsmeda. You can find the show on Twitter and on YouTube at Milkshakes Pod. We appreciate you joining us, and we hope you do the same next week. See you all real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.